G'day folks, welcome back to another update for the S&P 500 and the NASDAQ. Now, they've broken resistance since our last update, but still watch that divergence. That's still in play. And before we go any further, make sure you hit that like and subscribe button to support the channel, and also reference the +1 videos where we look at various strategies with a deeper dive, which we could be discussing today. In terms of the outlook as of today, October 4th, the S&P 500 outlook points to a steady broad-based earnings growth to around 10%, with moderate sensitivity to interest rate cuts, supported by sector rotation and monetary easing, though valuations remain rich and vulnerable to inflation surprises. The NASDAQ, meanwhile, is more volatile but carries stronger upside potential, driven by AI, cloud and digital transformation themes. However, its higher valuations make it more sensitive to rate shifts, regulatory pressures and earnings disappointments. Overall, the S&P 500 offers stable broad market returns, while the NASDAQ provides higher growth but higher risk exposure. So looking at the S&P 500 first, on the weekly, the price is very bullish, well above the moving averages, and also on the CCI, that's also above the moving averages, giving us a bullish momentum on the weekly. But however, notice we do have a bearish divergence currently still in play. It's risen slightly since our last update on both the CCI and the price, so lower highs on the CCI versus higher highs on the price, and that's still rising. So I'm not going to draw a target range for it yet until we start to see a significant downside for it in terms of divergence. On the daily, we had a resistance up here at 6,700 from our previous update, and it's actually broken through that in the last couple of days of trade. However, notice we've still got a bearish divergence as well on the daily, lower highs on the CCI versus the same period. If I can just get that trend line going higher there. So again, a bit early yet to start tracing a downside risk or downside target until we see this moving towards that moving average range on the price. By that stage, we should also see the CCI break to the downside. And at this point, I'm going to move that resistance to that new level as well. That's the daily. Now, even if you're trading on the daily, we also look at the 1 hour time frame for any micro moves. And by that, I mean, working backwards, you can see here we've got declining CCI versus higher highs on the price, and that's already looks like it's pulled back and hit its minimum target range. So we draw a Fibonacci down to that significant low. You can see there it's already penetrated the 23-38% range as a minimum. Now it could just fluctuate in that range for a while, then bounce out of there to the upside, or it could fall further. And looking at the CCI, it's still in a decline below the moving average, with the moving average band also declining, so we might see that start fall further to the downside in the coming hours. Now if we go to the back test, we would have gone long from this period here when the price started bending up on the moving averages, and so did the CCI, already on an upturn. We also pay attention to whenever the CCI breaks into that moving average range, so closing out at the very latest at each of those touch points on the CCI. On the hourly, which if you're trading on the hourly, you watch the daily trend. So you're only taking long trades according to the price movement and the CCI movement. And again, paying attention, and I've zoomed out here deliberately for those new to the channel. I want to be able to see any bearish divergence. So each of these periods, whenever you see a bearish divergence, if you're in profit, take your money off the table and get out of the trade. You can see there that moving average range started to turn down. So that was in a decline. You would have got out of any long trades during that period and then started going long again. Just zooming in a bit, whenever that CCI and the price started rising, again started noticing a bearish divergence, and whenever that, especially when the price breaks below the moving average, the CCI is already giving you a bearish movement, bearish divergence, and you wait till you're getting out of each of these points whenever you see a decline in the CCI and the price breaks down as well, getting out of trades, and that would have avoided you taking it. So you can see there, let me just zoom in for that one for a moment. So you can see here, for example, the CCI is giving you an early warning to get out. You would have got out when the CCI touched that moving average band. So you would have got out somewhere in one of those candles there on the hourly. The price is still in an upswing, but notice that the price started pulling back there. The moving average band was in an upswing until such time as there when the moving average band turned down. So even if you held on to it, the price is already below. You would have got out with a bit of a slight drawdown. You would have got out there holding a number of shares there and not been hit with that bigger average down drawdown. Now, moving into where we are today, as I said on the hourly, paying attention to each of these bearish divergences and getting out whenever you see a decline after those divergences on the hourly. And where we are today, like I said, you'd be probably taking your money off the table. It's already broken below the moving average of the price, and also that the CCI is in decline. So even if you're holding a couple of contracts open there, you would have closed them out. Currently no contracts open, and you'd be out of the trade on this one. Also notice I've marked here on the daily for a moment, just zooming out. If I zoom right out to a bit of history, you can see right back there, right to the September 2000, we had the dot-com bubble. There was a bearish divergence there, and we finally had a bullish divergence than that where it would have been we started going long. So I've highlighted, obviously there are a lot of smaller bearish and bullish divergence throughout the whole history. I've highlighted here the main events. So here the 2008, 2009 global financial crisis, again a bearish divergence. Then you had a bullish divergence showing you the recovery. Again, I'm highlighting the main ones here. This was the drop due to the China slowdown and oil price collapse. This was the COVID crash. This was the 2022 inflation Fed tightening, and up until recently, start of 2025, we had that, and I haven't marked that as a major event yet, but you can see there that was also a bearish divergence, and we've still currently got a bearish divergence in place, so just be cautious. So I'm showing you that deliberately. Never ignore these divergences throughout history. Before I get stuck into the three charts, this is the daily NASDAQ, again highlighting the bearish divergence of each of these little declines throughout history, going back to 2021. I haven't highlighted the main ones, but again, they would have been bearish divergence. Just looking at it there, you can see eyeballing it, lower highs on the CCI there versus higher highs on the price. That was another decline there in 2018, 2019. Another one there, decline, increase, and so on. So again, always pay attention, and that's just zooming out to the main events. So of course, there are a lot smaller divergence throughout the history. Okay, so looking at the NASDAQ 3 charts here, on the weekly first off, you got the bearish divergence, as I said. On the weekly, the CCI is still bullish above the moving average band, and so is the price, although that's, since our last update, that's risen slightly. So that bearish divergence is still in play. On the daily, again, similar to the S&P, we're just going to extend that to that point there. That's still a bearish divergence versus the price, and we're going to move that resistance line to that level there. So that's still a bearish divergence on the daily, but somewhat bullish at the moment with the CCI and the price above the moving averages. Although I notice the moving average on the CCI is very constricted. That's a consolidation period, so we might see a break to the downside soon in support of that bearish divergence. What I'd like to see is the moving average bands on both the price and the CCI expand like they did back here. That would have been a nice little bull run to jump on. On the hourly, so even if you're trading on the daily, on the hourly, again, you can see both the price and the CCI broken to the downside, hit that resistance at 24,990. So that's a bearish momentum on the hourly. So if you're trading on the daily, avoid going long until we see the hourly also break to the upside like it did back here. And also notice as well, we had a bearish move there, lower highs on the CCI versus slightly increasing highs on the price. Again, that's a bearish divergence, and to draw the Fibonacci retrace to that significant low, and a minimum retrace range was at 38% range. You can see there it bounced right off that 38 and it's currently sitting there at the moment. So at the moment, bearish momentum on the hourly. So if you're trading on the daily, don't go long until we see the hourly start turning bullish as well. So I'll just get rid of that Fibonacci for a moment. And then we go to the back test. So again, going long from this period around about April 2025, and that equates to this period here on the 1 hour chart. Now, during that whole period, most of that would have been nice little trades. A few little average downs happened. Again, paying attention to these bearish divergence scattered throughout the whole period. And you would have closed out your positions whenever you see both the bearish divergence, or at least see, and you're in profit, seeing the price and the CCI in a downtrend. Again, notice here you've got a bit of a drawdown or massive drawdown after making good returns, massive drawdown, and you would have avoided that by following the basic rules. And you can see there, just eyeballing it from this level, higher highs on the price versus lower highs on the CCI. You would have got out there right at the very beginning. You might have had 1 or 2 contracts open, but still that would have saved you from hitting the main drawdown. So again, always pay attention to the divergence. So if you enjoy the content, subscribe at least on the free trial to the Patreon page where I publish weekly bullish shares. across regions of the world's markets. Hit that like and subscribe button. Thanks for watching, and see you in our next video.